Good evening, everyone. Welcome to our University of Florida Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to be a part of tonight's class. Really excited to be able to bring this content to you. This is a class that we put on for the alumni community 4 times per year. This is a very interactive session, and so as we go through tonight's content, we encourage you to ask questions of us. You can do that by using the chat feature in Zoom or the Q&A, whichever you prefer. I'll be monitoring both of those windows along with my colleague Ken, and we'll make sure we get your questions answered on air. This is a class that we're in the first year of teaching, and I will have to say we've had some wonderful results in supporting the UF community in homeownership education. In fact, some of your very own fellow alum have actually purchased homes this year with us. In fact, we have another clients that are actually buying their home in just a few weeks. They'll be homeowners, and they actually came to the exact same class that you're attending to this evening. So we hope that you guys get a lot of great takeaways from tonight's class that can really help support you on this journey towards homeownership. Well, our organization is called American Pacific Mortgage, or APM. We are a nationwide lender. We're the 9th largest lender in the country. And our team in particular, we basically put on classes like this to support our local communities in homeownership, just to provide them educational tools so that as they're figuring out, is this the right financial decision for me, they'll have a good kind of a baseline of what home buying looks like, and then they can decide to make that decision. And hopefully we're their lender of choice when they do decide to purchase a home. And so as we kind of dive into tonight's class, I want to share with you our talking points. Now, before I do that, I'd love to kind of get a sense of where our class is joining us from. We've had a lot of signups for tonight's class, but it would be great to know either A, where you're located at, or B, maybe where you're thinking of buying. So maybe you're in Gainesville now and you're looking to buy in some other city. It'd be great to kind of get an understanding where you're joining us from or where you want to buy. So if you can just want to drop that in the chat, that's always kind of helpful for me, because I know just because our Gator alumni is not necessarily just in the Florida market, even though we'll talk about Florida and what's going on housing wise there. But certainly if you're looking at other states, this is obviously a nationwide community, we'll certainly talk about other markets as well too. So those of you that are dropping that in the chat, thank you so much. That's awesome. And we'll definitely kind of go back to that in just a bit when we talk a little bit about market data. And we do have a lot to talk about in the market. Today was a big day. There was a Federal Reserve made an announcement on the federal funds rate cut by 0.25%, which we kind of expected. We're going to talk more about that, what that means to you as consumers in just a bit. But let's talk about our talking points for this evening. We're going to spend some time, like I said, look at the housing market. We'll kind of take some data in on what's going on across the country in the housing market. We'll also look at interest rates, trends, projections. Again, I'll comment a little bit more about what we heard today from the Federal Reserve. I do want to launch in tonight's class talking a little bit about a rent versus buying calculator, one of the tools that we provide to our buyers just to better understand, does really buying make sense for me in taking those next steps? I also want to spend some time looking at credit and how can we help build your credit, but also give you some tips and resources around improving your credit, looking at loan programs that are available to you. And we will talk about first-time homebuyer programs as well tonight. And then we'll look at planning for homeownership, essentially saving for homeownership, which essentially can be one of the tougher hurdles for most of our buyers, is just to have enough saved for homeownership. So we'll dive into that. We'll also look at the buying process. So after you leave tonight's class, you want to learn, hey, how do I get started in the process? I'll kind of walk you through that. But as you begin that process, what are some of the milestones that you'll experience in the home buying journey? And again, give you some links to maybe start the process with us. All right. So we're excited to present this content to you. Again, if you do have any questions, just use the chat or Q&A function in Zoom, and I'll make sure to monitor those and get those questions answered for you as we roll through tonight's content. Our runtime for our class usually takes us about to the top of the hour, okay? And we are going to record tonight's class, so if you have to step away from your computer for a second, we will record this. It will be up on our our YouTube channel tomorrow. We're going to send you out the link for those that signed up for tonight's class and share back all the material with you as well. All right? Okay, so let's dive in. Let's think about home buying a little bit more, right? So when we think about purchasing a home, it's probably going to be, like I said, the biggest financial decision we decide to make. There's a lot of great benefits that come along with owning a home. And so that's why when you go through a class like this, we want you to have some takeaways that you can understand, like there's a true comparison of budgeting for renting versus home ownership. The first thing with home ownership, you have the opportunity to create more of a fixed housing budget, so you're not worried about your landlord increasing the rent. And a topic of a lot of conversation for some of our existing homeowners. So these are clients that have bought with us over the last 2, 3 years. The consideration of refinancing your home, where you're trying to bring down your interest rate to improve your outgoing expenses, because interest rates have gone lower since some of those clients have bought. So that has the ability to change their monthly budget for their home that they're paying on. Also, this is an asset. So this asset hopefully will grow over time as that home goes up in value. As I make payments to pay down my mortgage, I create home equity for myself. And for most of us, that is our number one asset that we have, is home equity. And that obviously has the huge opportunity to create generational wealth for some families. And when you're a homeowner, you do have some tax benefits that you can realize that you don't get potentially as a renter. Also, if you make energy efficient improvements to your home, that can also result in potential tax benefits for you as well. So there's a lot of great things that come along with home ownership. And I would encourage our class to kind of think a little bit more about, that comparison, because as you think about your continued rental budget today and then plug that into what it looks like for a home ownership standpoint, not necessarily the same thing, because there's going to be a lot of great things that come along with home ownership. And we're going to calculate that out now that you don't realize as a renter. One of the tools to help you kind of realize those gains in home ownership is what we call a rent versus buying calculator. You can find a calculator like this in our Homebuyer resources hub that's available to you. And so we're going to walk through the calculator for you now, because I think that's really important to understand, like, how long is it going to take me to break even on investing towards home ownership versus continue to just kind of go through the monthly exercise of paying on my rental every month, right? So let me kind of break this calculator down for you. This is a great way to kind of start into today's class. Essentially, and by the way, since we're going to send out all the material, I would encourage you to go through this calculator yourself. But it starts like this. So you have your home price noted here. So we put 400,000 as a what if. You have your minimum down payment of 3%. Then with that 3% down payment, I would essentially be financing 97% of that purchase price, which would be 388. We put an average interest rate, which we're going to talk about in just a bit. We put a term of our loan, which is 30-year fixed. And then we make the assumption that in this scenario, this buyer is going to purchase sometime in September, right? Now, when we purchase a home, we put less than 20% down. There is a thing called mortgage insurance that you will have. And we're going to talk more about mortgage insurance. We have a special segment for that. But ultimately, mortgage insurance comes into play when I put less than 20% down. I have homeowners insurance costs, which will vary based upon where I'm going to buy in the country. So some of us in the Florida market might be paying more insurance costs than, say, someone in the Colorado market, right? We have taxes that will vary by location. And then for some of us that are interested in maybe condos or townhouses, there might be HOA expenses attached to that. The other thing that plugs into our calculator is, what tax bracket do I fall into? What is it going to look like in terms of my annual expenses for my home? If I decide to sell my home at some point in time, what's those costs going to look like? And then how much is my home going to appreciate over time? And so in this scenario, we just put 3% as an annual appreciation goal. And then now under the rental assumptions, we have someone that's renting at $1,700 a month. Rent goes up 1.2, or sorry, rental insurance costs are 1.2% of my rent. And then my rent will go up 2% on a annualized basis. All right. So that's kind of with the backdrop for our comparison: renting for $1,750 versus buying for $400,000. So what our calculator essentially tells us is that after year 4, it makes sense for us to buy versus deciding to rent. So that means my break-even point is at 4 years of owning versus renting. Now, when we kind of dig in a little bit further, and let's say we go out even further in the years. So let's say now I'm going to retain my home for 8 years in this example, right? At the 8-year mark, it makes more sense for me to own a home by $41,000 versus it is to rent for the last 8 years. And how I achieve that number is by the appreciation rate in my home, and of course the tax benefits that come along with my home. So as I'm seeing my home hopefully go up in appreciation or value, as I pay down my mortgage, now I'm building more equity in my home, and then I'm also taking advantage of tax benefits. So that's kind of really where it is with home ownership. And so I always encourage clients to walk through a calculator like this. We'll take you through this as well during a consultation so you have a better understanding of that. But that's really the difference of renting versus owning. Now, if you're looking to buy a house and try to be in that house for 3 years, probably doesn't make as much sense. You probably would want to continue renting. But if you're looking to kind of plant your roots, so to speak, own a home for the next 5, 6, 7 years, it certainly does make sense to own versus rent. And certainly depends on what you're paying in rent right now and what you're looking to achieve in home ownership. So I would encourage you, walk through that calculator when you have some time. I think that's a great way to kind of launch into the discussion with you or maybe your partner around home ownership. Now, the housing market and kind of what's going on with it is also going to play a big role in when do I enter the market, right? Now we're in an interesting time in today's market because the market is flattening a little bit. In some markets, we are seeing inventory starting to stack up. Now that might change in the next few months, especially with the recent activity we've seen around interest rates. But Florida is actually 1 out of 4 states in the country right now that has seen an uptick in inventory. In fact, it's one of the highest inventory or supply states in the country right now. Florida, Texas, Colorado, and Georgia, and I think we have in class everybody representing in one of those states here. And so those are opportunistic markets for buyers because ultimately those are buyers markets right now. And a lot of parts of the country have changed into buyers markets. And what that means is essentially we have an uptick in supply, and you can see this reflected in the Florida market numbers, right? So average days on market is 79 days right now. You're seeing the median price slip a little bit year over year. That's a 0.17% difference. Things like cost of homeowners insurance is really driving down the Florida housing market. Obviously, the interest rate market has played a big role in that. These are all elements that many other parts of the country are feeling as well too. And so we're going to have to watch this really carefully over the next 2 or 3 months, but it is opportunistic for buyers. I do think many buyers want the perfect storm of the lowest possible interest rates, the lowest possible prices of homes. It just doesn't work that way, unfortunately, because that combination doesn't add up. Because ultimately, if prices are falling, that doesn't mean interest rates are necessarily falling. Now we're seeing a little bit of like slipping in the housing market, but not necessarily a full drop off. Now, we did have some good news on the interest rate front today. So the Federal Reserve, as expected, cut the federal funds rate 0.25%. And I think it's important to know as future buyers what that means to you. We already kind of assumed that in the mortgage pricing that rate cut was going to happen. So we over the last week have seen interest rates fall on mortgages pretty significantly. In fact, we've seen about a 0.5% drop in rates. So we already knew today's announcement was going to happen. What we were more concerned about is what is going to happen next. And there is indications that we might see another 2 rate cuts before the end of 2025, which should be welcomed because if we get more clarity on that, we'll probably see mortgage rates go even lower. And that is a really encouraging sign for our buyers to create obviously better affordability. But it does mean many buyers that have been on the sidelines for the last 2 years, while rates were at 7% plus, are now going to probably re-enter the market. So we'll have to see, like I said, how that kind of plays its role in, we have a lot of supply right now, but if we get a lot of buyers jumping into the market, that supply starts dwindling. And then, we might see price stability in housing, or maybe prices go up a little bit because not all markets have a backlog of inventory like states like Florida, Georgia, Colorado, Texas, right? So, good news on the interest rate front. One thing I would also add to with the federal funds cut today, the 0.25% doesn't mean a 1-to-1 ratio cut for mortgage rates because like I said, it's already baked in. But what it does mean for you as consumers is that you're going to see a cut in credit card interest rates. Probably the yield that you're getting in your high yield savings accounts is going to go a little bit lower. The cost that you pay for your line of credit or personal loans or even new auto financing is going to go a little bit lower. So right now we're at about a 1-year low in interest rates. This is kind of a 12-month snapshot of interest rates. We actually got to push this out a little bit further on this graph because this would actually show lower than this level. So good news on that side. The trend is for interest rates to go lower. It's just going to be how fast do they go lower. But I do think that presents a huge opportunity for us as buyers. Now, I just want to also give you kind of perspective over the last 20 years. Interest rates do cycle. In fact, I was talking to a future buyer here this morning. They're asking, well, what's the historical averages on interest rates? Well, if we look at the last 20 years, you would look at an average rate of about high 4s to low 5s, depending on what cycle we hit. But interest rates will cycle. We unfortunately have been in the higher cycle coming out of the pandemic, and now we're starting to go lower. The other thing as it relates to the pandemic, I would mention to our class is that, we're not going to see rates return to the pandemic levels of 2.5%. I mean, that was obviously a catastrophic event for our globally. Unless something like similar to that occurs, we won't see interest rates go that low again. But like I said, the average interest rate historically usually is in the high 4s to low 5s. Now, for mortgages, all interest rates are not the same for every buyer. There's various elements that go into a rate, like things like what my credit score is, the eligibility for a loan program, how much I'm going to finance, and how much I want to put down for my down payment, as well as the selection of maybe putting additional funds out of pocket to bring down my interest rate. That's called paying discount points. I don't recommend clients doing that in this market because the likelihood that someone's going to get the break even mark on investments like that is not very high, because usually 1 point is the equivalent of 1% of my loan amount. That brings down my interest rate about 0.25%. It usually takes about 3 to 4 years to break even on those kind of investments. And then the term of my loan can also change what my interest rate looks like. Usually, the shorter my term is of my loan, the lower my interest rate is going to be. Now, ultimately, as we meet with our clients to design their home buying plans, we're going to figure out what the right kind of design work looks like for them, whether it's the term of my loan, the down payment, even the incorporation of like assistance programs to help design the most affordable option for them. But that kind of gives you a sense of what interest rates look like and how they're kind of made up. Now, credit plays the biggest driver of my interest rate. And so we like to, in our classes, talk about how to optimize your credit score, because that is going to influence your borrowing costs. Now, every loan program has a minimum credit score, and you can see some of these core programs listed here with their corresponding minimum scores. So that's the minimum kind of entry point for those programs. Now, in lending, we always look at all three agencies' reported scores. And you guys are all familiar with the agencies. There's Equifax, Experian, and TransUnion. We look at the middle score of all three bureaus. So if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, we're going to take the 740 score to qualify us for our financing. So we look at the 740 score. Now, if I'm going to apply with my partner, and let's say my partner's at 700, 680, and 660, well, we're going to use the 680 score for qualifying purposes. So we always take the lowest score between both borrowers. Right? Now, when we think more about our score, elements or items like major credit events that could impact our score, things like a bankruptcy, maybe collection accounts, late payments, they're going to have an effect in the most recent 12 to 24 months from the date of the event that happened. So if I had a late payment on a student loan back in October of 24, I'm probably seeing the effects of it still in my credit score today. But as I move past 12 months of that event, as I get to 24 months, I'm going to see incremental lift in my credit score. We're going to talk a little bit about credit utilization in just a bit, as well as inquiries and how that impacts your credit score. One thing I will just talk to you really quickly about is account closure. And I talked to a client about that earlier today, which was essentially when you close out a revolving account, so a credit card. So let's say you're doing a balance transfer, but you no longer want to have a relationship with that particular credit card company. If you close out that account, it can lower your credit score, because that could be a long-standing account that you've had, but if you get rid of it, it pulls away all the relationship history out of the credit model. Also takes away from a credit limit that you could have in your like credit utilization or credit availability. Now, if you've had late payments or events that are impacting your credit score, this is a matrix that you can refer to see how long it's going to stay on your credit report. Now, the impact to your score, like I said, is in the most recent 12 to 24 months, but this is how long that they will appear on your credit score, or credit report, I should say. Now, there are three different models to credit scoring. There's a credit card score, and by the way, that's the model that's used for your credit monitoring. There's also an auto finance model. So when I go decide to buy a car, and then of course in the housing space, there's a mortgage model that we use to determine your financing options. So let me walk you through kind of how that's weighted, because as you look at each one of these areas, you can hopefully identify maybe your own area of opportunity as it relates to maybe lifting your credit score a little bit. So 15% of the score is going to be how long have I had credit? So the longer my credit history is established, better my score is going to be. I gave you the example of account closing. So you want to really limit closing out accounts, because if you do, especially when you have long-standing accounts that are longer relationships, that's going to impact your score by 15%. In use or new credit, that means what type of new accounts am I trying to open up? Do I have lenders doing inquiries on my credit? That is going to have a 20% impact on my score. Now, one of the things we do a little bit differently with our process is, as you work with us to develop your home buying plan and decide to submit your application, we only do a soft inquiry. And the reason why we choose to do that is because many of our clients have varying buying timelines, and so we want to give you all the tools and resources and construct a plan for you without impacting your credit score. So we always start with that soft credit check first. And obviously 20% of your score is a big deal. 30% is going to be around credit utilization. That's essentially looking at your revolving accounts and comparing your balances that are outstanding versus your credit limits. So for example, if I have $10,000 in limits and my balances are $6,000 right now, currently I'm at 60% utilization of credit. Now, that's a little bit on the high side. So our first area of improvement or level we want to reach is to get to 50% utilization or a $5,000 balance, and then eventually get to $3,000 or 30% utilization. And then the optimal level is to get to 10% utilization of credit. Now, if you were to take a look at one of your credit card statements, here's my tip for you tonight to manage your credit card debt. When you look at that credit card statement, there's two important dates. There's a due date. There's also a billing statement date. Now, the due date, of course, is when your payment's due. The statement date is when the reporting information goes out to the agencies. So my tip for you tonight in class is if you can try to pay down that account before the billing cycle date ends, what you're going to do is you're going to catch that account before it reports out to the agencies. Therefore, if you can pay it down or pay it off, bringing down your lower balance, therefore improving utilization and then lifting your credit score. All right. So just kind of switching things up a little bit, paying it before the end of the billing cycle date versus the due date. And then the last section of the weighting is payment history. How have I paid my bills? That's pretty simple. Have I been on time with my payments or not? If I've had some late payments, they're going to be rated as 30-day lates, a 60-day plus day delinquency, or a 90-plus day delinquency. The more severe, the higher my days of delinquency is, bigger impact I'm going to have to my credit score. All right. Now, in credit, in kind of the evaluation we do when we work with our clients, we also take a look at installment debts known as student loans. And for some of us in class today, we might have some of those accounts. Student loans are kind of in an interesting position right now because some are coming online for payments, and we're seeing that from some of our buyers. Others, we're kind of still in forbearance right now, kind of the after effects of the pandemic. So still forbearance, or we have some clients that are in deferment right now because maybe they're back in school. It's important as you're thinking about going to the next steps in home ownership, we have to look at or assess a minimum payment for qualifying. So if you're in an active repayment right now, let's say a savings plan, which is known as an income-based repayment plan, if I have $75,000 in student loan debt and that plan is set up for $250 per month, then I can use $250 to qualify for my mortgage today. Now, if I'm not in an active repayment, let's say I'm in forbearance or deferment, then we have to either assess 0.5% of the balances on an FHA loan or 1% of the balances for a conventional loan. So that's really important to understand because I get a lot of questions around that. Ultimately, the takeaway is if you're in active repayment, we're going to use that payment right away. If you're not, then we would have to assess that calculation for those student loan debts. And, we also see some situations where clients have payment arrangements for their student loans, but they're deferred out. So maybe they're not starting their payments to December of 2026, whatever the case may be. If you're in active repayment, we have to see that you're actually paying those payments today. All right. Now, some of us are in public service positions where you have forgiveness of debt after 10 years. That's great. But if that has not been forgiven at this point yet, then we would still have to assess one of those payment options for qualifying. Now, the reason why we have to do that is because every loan program, which we're going to look at now, has various guidelines that look at how we view student loan debt and overall minimum credit scores. So we're going to dive in from a high level perspective, look at some different loan programs. I'm sure you guys have heard this terminology before, but let me kind of take you through each one of these products. First one is the conventional loan. When we think about conventional, also kind of connected with Fannie Mae and Freddie Mac, so you might be more familiar with that. A conventional loan has a minimum down payment of 3% up to a loan amount of $806,500. That's called the conforming loan limit. That loan limit is set every year, right around October, November, based upon previous cost of living data. That generally goes up every year. No surprise, just given the cost of housing these days. Now, I don't think any of us are in a high cost of living area from what I saw in the chat, but for those of you that are considering buying in high cost of living areas, maybe New York State, Virginia has DC, I think I saw somebody from Maryland, but if you're looking at DC, California, there are high cost of living areas that allow us to go up to as high as 1.209750. That's called the high balance loan limit. But it does, when you go beyond 806,500, the minimum down payment jumps from 3% to 5%. All right, so that's called the conventional loan. FHA loan is a government insured loan. FHA stands for the Federal Housing Administration. Since it is government insured, there are some guidelines. In fact, we've had some guideline updates recently. In fact, 2 months ago, there was some changes around residency for government insured loans. For both the FHA and USDA product, you do need to be a permanent resident to access those programs. So unfortunately, that change was made recently. Now, you can still be a non-permanent resident and access the conventional loan, but today on the government insured products, you do have to be a permanent resident. With FHA, it's a minimum down payment of 3.5%. You can see the minimum credit score there. And then that maximum loan amount will vary based upon the county that we want to buy in. And then the USDA is also another government insured loan. That USDA is more for rural purchases. So if I'm in a rural area that I want to buy in, allows me to purchase with no money down and have a little bit more flexibility with loan amount. That loan amount does change by county. There's two qualifiers to USDA. It's about the location of the property. So the USDA website has designated rural areas, and then it looks at household size and the income that my household is generating. All right. And then I just want to kind of quickly go over the jumbo products. Some of you might want to get access to that product. That essentially is for buyers that need more buying power that stretches beyond some of the conventional guideline limits. But it does come with higher down payment options and higher credit score requirements. And then finally, the VA home loan is for our veterans that have eligibility for the VA home loan. Has a lot more flexibility and leniency for the veteran to get access to home ownership with a zero down payment option, no real maximum loan amount for the veteran. And of course, the veteran needs to have eligibility for the VA home loan. All right. So that's a kind of a look at loan programs. Now, I want to talk a little bit about mortgage insurance. And I mentioned to that a little bit earlier when we went through our rent versus buying calculator. I get a lot of questions around mortgage insurance. What is it? How much does it cost? What does it do? All that kind of stuff. Well, there's two forms of mortgage insurance. There's conventional mortgage insurance, and we call that PMI or private mortgage insurance. Then there's FHA mortgage insurance, which is government mortgage insurance. Now, both forms of mortgage insurance provide insurance for the lender against default by the buyer. So if a buyer went through economic hardship, couldn't make their payments, the lender would be essentially insured against the default by the buyer. So that expense does come on the buyer's side in lending. And let's look at how conventional mortgage insurance is calculated. So it looks at down payment, it looks at credit score, and it also looks at amount financed. So the higher I can lift my credit score, the more I can put down, the lesser costs I'm going to see on the private mortgage insurance side. We have about 7 to 8 different PMI companies that we partner with. It's very similar to car insurance, so we can certainly shop around for the lowest rate based upon our client's profile. Now, one of the benefits of the conventional PMI is that once I reach 2 years in my loan and I have 22% equity, I can apply to have my mortgage insurance canceled. All right, so that's one of the added benefits for conventional. Now, I hear from clients often that they've been kind of shopping around online and the mortgage insurance costs look super high online. And so I like to always kind of share with them a PMI example because it's actually not as high as you might think. Some of the calculators on Redfin and Zillow are much higher because they're not like calibrated to some of the features here that we just listed. So if we looked at a 450 amount financed and we're putting 3% down and our credit score is around 740, the mortgage insurance cost is about $138. So not as expensive as you might think. Obviously, as I can raise my credit score, as I can put more money down, I'm going to see that mortgage insurance decrease. Now, FHA, regardless of my credit score, and really to a certain extent, regardless of what I put down, the mortgage insurance costs are going to be the same. So there's two forms of mortgage insurance with FHA, and we call that mortgage insurance premium. There is upfront mortgage insurance, which is 1.75% of my loan amount. And then there's monthly mortgage insurance, which is 0.55% of the loan amount. And then we divide that by 12 to determine a monthly figure. Now, with FHA mortgage insurance, there is no cancellation option. So the only way to exit FHA mortgage insurance is to refinance generally into a conventional home loan product. So here's what the calculation looks like for an FHA loan. So if I took my same comparable loan amount of 450, I have my upfront mortgage insurance of 78.75, so that gets added into my amount finance, and then I have the monthly mortgage insurance, which calculates out to 206.25 per month. So as you're hearing kind of the different scenarios, you might ask yourself, why would I go with FHA? Because it clearly looks more expensive than the conventional product. And you're right. However, every product has guidelines, whether that be from a credit minimum perspective, whether that looking at employment, whether that's looking at, past late payments or whatever. FHA is going to have a lot more leniency when it comes to guidelines than we might see from a conventional loan product. Now, as I get a chance to meet with you to design your home buying plan, we're going to figure out the right product for you. But that kind of just gives you a sense of those PMI differences between the two product sets. Now, as we're kind of moving along in class, we're going to talk now about employment when it comes to applying for home ownership. Now, I like to kind of just, first of all, before we talk about different scenarios for employment and income scenarios, I wanted to kind of share with you just some of the general documents that we'll ask for in the home buying process. So as you decide to do your free consultation with us and kind of design your own plan, these are generally some of the documents that you would want to start gathering. And of course, you can upload these documents. It's fairly easily done. But that's generally what you would expect to see on the home buying process side. Now, let's talk a little bit about employment. And I get a lot of questions around, is my employment eligible? Do I have to be on the job a certain amount of time? Hey, I just graduated school. I'm getting ready to start my job. What does that look like for me, right? Well, there are rules in lending that require us to verify 2 years of employment history and or educational background. So in a scenario where I just graduated from UF, let's say in the spring, and I'm getting ready to start my job this fall, right? I'm all ready to go in my position. If I can put together at least 2 years of education history, I shouldn't say at least, well, 2 years, but probably 4 years education history or employment, then I can qualify with my new salary that I'm going to be receiving this fall with my new job. So there's a misconception out there that I have to have 2 years on my job, which is just not the case. You just have to string together a 2-year work history or educational background. Now, you can even have a scenario where you're getting ready to transfer jobs. And let's say I've been working for in a state position for the last 2 years, and I had this new job opportunity to go into the private sector, but I'm not starting the job until November, but I really want to buy a house right now. You can potentially use your new starting income for November to buy now, as long as we have an executed offer letter for that new employment. So that's one of kind of the things that a lot of people don't realize either. Now, where the 2-year rule gets a little different or tricky, I guess, if you will, is if you have a situation where you're in a variable compensation position. So let's say you have a base salary and then you have bonus income or you have overtime that you get. In that case, we do have to show that you've been on your job 2 years in order to count those variable sources of income. Some of our clients that are in tech or startup situations, they get RSUs or restricted stock earnings. We can potentially use those as income, but another scenario, they have to at least show that they've been on the job for 2 years. Also, another scenario that comes up is that clients that have multiple sources of jobs. So let's say they work for 2 employers. If they want to count both sources of income, then I have to show that I've been on both jobs simultaneously for the last 2 years. If I'm self-employed, that also is a 2-year requirement that I have to show 2 years of tax filing in order to count that income towards my qualifying. All right. And last thing I wanted to share with you is that, when we have other sources of income, so sometimes we'll have clients that apply on their own, but maybe their partner's contributing to the household expenses. They have an income source, but they don't want to be on the application. In order for me to count that income, I do have to have that person as part of the application. Otherwise, I can't count the income. Even if I'm getting like rental income today from a roommate, that income doesn't carry it forward into the next property. All right. So that's kind of a little bit of a look at income. Now, we also look at expenses versus income. We look at a calculation called debt to income ratio, which essentially looks at my projected housing expense that I'm going to have when I purchase my home and my existing expenses. And then we compare that versus your pre-tax income. So for example, if I'm going to purchase my home this year, and let's say in this scenario, I have a $2,500 housing expense. That's inclusive of my principal and interest of my loan, my property taxes, my homeowner's insurance, maybe mortgage insurance if I have to pay that, as well as maybe HOA expenses or homeowners association dues. Let's say I was spending $2,500 a month in my projected bill for the house. And today I have $800 in current payments. So today, right now, I would have $3,300 in projected expenses with the new house payment. And if I'm making $8,500 a month, that means my debt to income ratio, meaning my expenses versus my income is 35%. All right. And that's one of the metrics that we look at for eligibility for qualifying. That number cannot be any higher than 45 to 50%. If we look at kind of our slide here, an excellent level would be probably below 36%. Most of our clients that I work with across the country, they feel like their comfort zone for debt to income ratio is about 33 to 36%. That's generally where we see kind of the sweet spot for most homeowners or prospective homeowners, right? Now, what's most important for us is affordability for you. We want to make sure that we design options for you that make it affordable and sustainable over time. So if there's any kind of road bumps along the way economically for you, that you can still afford your home. All right, I know we're kind of moving along. I haven't seen the questions in the chat, but I'm just going to kind of pause there really quick because we're doing great on time. But is there any questions from the audience that I can help answer before we talk a little bit about down payment and kind of savings for home ownership? Okay, I think we're good. I don't see any chats coming in or any questions coming in. So let's kind of keep it rolling. And let's talk a little bit about down payment. And that, like I said earlier, when we launched into class, is probably one of the bigger challenges for most of our buyers because we're just not there maybe financially yet. So I want to give you a savings plan to help you or equip you for getting to those savings goals. But let's, before we get there, talk a little bit about how we source savings for our home ownership. So we can use various asset accounts, things like checking and savings accounts. Cash is not acceptable in lending at this point. So not at this point, it's not acceptable. We have to paper trail all assets used in a transaction. In fact, one of the questions I got today, which is appropriate for our class today, is can I use cryptocurrency or electronic currency for my home purchase? So today we cannot. It's not recognized as a asset in lending. At some point that probably will change, but all assets need to be at least seasoned 60 days to be used in a home purchase. Now you can use things like 401ks, 403bs, brokerage accounts. I would just always encourage you to talk to your financial or tax advisor before you do that, because I don't want to create any tax liability for yourself. Now, gift funds can be used where you have a family member that essentially is gifting you funds towards your home purchase. There are no seasoning requirements for that, but there is a documentation process that we have highlighted there. So we'll generally have the donor provide a gift letter that we have a template for. They'll provide proof that they have the asset, and then they'll wire the funds into the transaction. All right. Now, I did get some questions in the chat. I'm going to answer those really quick, and then I want to walk you through a savings plan. Question was, if I want to help my senior in high school prepare to purchase a house, what would be your best recommended steps? So I would encourage them to, it is obviously a little bit early, but hey, for them, graduating high school here soon, and then being able to have them financially prepared. My first step would be to help them establish a credit history, which basically you can do so if you have an active credit card where you can add them as an authorized user to one of your accounts, because that'll start to get them on the grid when it comes to credit score. And after they graduate, now they'll have credit established, and so as they have an income, they're going to be able to start now looking at home buying options. Now, as they graduate, and depending on what their next steps are post high school, you may want to consider purchasing a home in conjunction with them. So those are questions we can certainly answer offline for you. But I would say a first step for someone that's just getting started, whether it's, even just graduating college or graduating high school, let's get the credit history established. And a great way to do that is kind of piggyback on the history that you've established as a parent with an authorized user. All right, thanks for that question. Another question I'm going to answer, and then we'll keep it moving. If I'm a seasonal worker, how would I need to show income? For example, I'm a tax preparer, so I earn all of my income within the first 4 months of the year. So you can certainly be a seasonal worker and be eligible for financing. In that case, we just have to show that you've been doing that actively for 2 years. And then what we do is we average the last 2 years of income that you've generated from that position. All right. Thank you for the questions. All right, let's talk about a savings plan. And, like I said, savings can be a challenge for some of us in home ownership. And so when we think about savings for home ownership, it could take us a longer period of time. Now, there are assistance programs that can help you as well. But I want to help you kind of get started today. And here's a really simple approach. And I had a really cool success story last week from a client that 12 months ago was not ready to buy because they didn't have the money on hand. but he applied this simple approach that I'm going to take you through now. And now he's actively making offers on homes. And so it looks like this. So let's say I'm spending $1,500 a month in rent. I feel pretty good about that, but I know I can project a mortgage payment of about $3,000. However, I just lack the savings for home ownership right now. So after meeting with us to design your home buying plan, you're just, hey, I'm not quite there. So what I would encourage our client to do is let's start saving today like I'm making the $3,000 mortgage payment. And this client, like I mentioned, started doing that 12 months ago and was able to build a pretty good nest egg of savings. So when I pay my rent payment on the first of the month of $1,500, I automatically transfer another $1,500 into my savings account. And I create that discipline in doing that every month because as I do that over the course of 6 months, now I have $9,000 accrued to my account. Over the course of 12 months, now I have $18,000. It can really start to stack up for us. It is a switch in budgeting ourselves, but it does two things. One, obviously, it builds our savings account, but it also gets us to kind of really transition into home ownership a lot easier. So it's not such a big sticker shock for us. All right. I see a hand raised up. I don't know if that's for a question, but if you want to throw a question in the chat or Q&A, I'll definitely answer that for you. And I did have a couple questions come in, and we're going to talk about assistance programs in just a bit. The question was, where did you get the 3% annual appreciation goal earlier on the home calculator? That's just a what if scenario we put in there for the 3%. So I would, obviously take a look at, and we can take a look at for you wherever market you're in. Certainly, we're looking at 3% appreciation annually. That could be 2%, could be 1%, could be negative in some markets. So it really just depends. Another question was, one of my goals is to attempt to have a mortgage rate similar to my current rent statements. This would require a larger down payment to my knowledge. Would you advise against putting down a larger down payment over 20%, as in like 30%, to achieve a lower mortgage rate? So that necessarily won't drive the rate. I think what we're trying to get to is monthly payment. It sounds like we're trying to, get something comparable with what you're paying in rent. The increased down payment may make more sense. Of course, the timing in which you're going to do something like this is going to play a role. What do home prices look like? Where are rates at? All that stuff. I think what we need to do is probably sit down over a home buying plan virtually and kind of talk through it and see where you want to land. I would also encourage you to use that rent versus buying calculator I shared with you guys earlier, because I think that can kind of paint a bit different picture for you, that you don't necessarily have to get to exactly what you're paying in rent, but certainly we can help you through that. All right. Okay, let's talk a little bit about some first-time buyer programs. I know we have attendees for a class all across the country. I think we have quite a few states represented, which is great. From a high level perspective, you do have a first-time buyer option in every one of your states that is represented today. Now, how the mechanics of those look or the resources will look a little bit different, but generally most states have what we call an HFA, as a housing finance agency designed to support low to moderate income households. Low income is considered below 80% median income, and then moderate varies by the state, but it's usually 100 to 150% of median income. And I can help you through that if you're interested in first-time buyer programs, as we build a home buying plan for you. But we're going to spend some time looking just quickly at Florida, just for a reference point. But, I know we have, Texas represented, for example. There's the Texas State Affordable Program, which has some really cool options to help first responders, but also there's assistance programs for just, your typical first-time buyer, relief on closing costs, down payment, also what we call a mortgage credit certificate program. So a lot of cool options there. So Georgia has the same thing. So I know we're well represented in different states, so we can certainly talk offline about that. For Florida's HFA, so Florida's Housing Finance Agency, there is the Florida Assist program, which can provide up to $10,000 in assistance, which essentially is a deferred payment. There's the HLP program, additional assistance program, that provides a forgivable loan after 15 years of occupancy. There's also the 3%, 4%, and 5% HFA preferred loans, and those are all conventional products. So essentially, we're able to cover the minimum down payment of a conventional loan, but then also get additional resources for maybe closing costs. And these are forgivable options. So we'll need to figure out which option suits you best based upon your eligibility for the program. And then Florida Hometown Heroes Housing Program, basically allows first responders to get special incentives. Also, educators, healthcare professionals, and childcare employees, and active military or veterans can also get special incentives with some of these programs. And that is true with other states in the country that you do have access to these type of similar resources. Nationally, within APM, we do have the Pathway DPA program that is FHA only, but it does allow 3.5 to 5% of your sales price in assistance. Usually clients that don't qualify in some of these state-based programs will look at these programs because they have lower credit score requirements and there's no income restrictions like we see in some of the other state-run programs. All right. All right. So that gives you a little bit of a sense of, some of the first-time buyer resources out there. We'd love to be able to run some of those resources by you to see if there's a good fit for you. All right, we're going to talk a little bit about the buying process because, after tonight's class, hopefully we've created a level of interest for you that you say, hey, this is something I think I can do. Well, we'd love to be able to get connected with you for a consultation. And that's where I meet with all of our clients for a 30-minute session just to figure out what homeownership could look like for you. And out of that meeting comes kind of the activated home buying plan, a pre-approval so you know exactly what you qualify. And so that pre-approval essentially starts us on this workflow here. So step one essentially is the pre-approval, which comes out of that consultation. A pre-approval is usually good for 60 days, but it can be recertified at any time. Your application when you apply with us is good for 2 years, so you don't have to feel rushed to go out and buy a home this weekend. It's something that's a very kind of fluid process. We encourage clients that as they're starting the home search, which is step two, to get connected with a local realtor in your market. Now, we're fortunate to have preferred realtors that we work with, people that we trust in the process. And if you need us to make a connection with a realtor, we can certainly do that. But a realtor should be a trusted advisor for you that understands all the likes and wants and needs, I guess, if you will, for the property that you're considering purchasing. They should have a good influence in their sphere of influence where they basically have good associates that they can help kind of get an idea of what's out in the market and have a good inspectors that are available for you, so when you have to do your home inspections they can rely on some trusted resources. But step two would be the house hunting phase. It usually starts online and then transitions to in-person. As you're going out and doing the home shopping, quite honestly, that's probably the longest phase of the process when we think about the workflow, because we might be looking at a certain location or neighborhood. But once we identify the property that we love and we want to submit an offer to a seller, the realtor that's representing you would provide the seller with a copy of your pre-approval, which comes from us, along with the offer of contract. That offer will then get submitted to them. And if the seller accepts your offer, then you move to the next phase in the process. That's called entering escrow. So a seller has accepted your offer. And when that happens, we get notified of that. We give you a call and say, congratulations, you did it. You have an accepted offer. Because quite honestly, in some markets, that's one of the bigger challenges for some of our buyers. Now, once that happens, we're going to get you connected with us so we can do a follow-up video session to review all the ingredients of your home buying. Now that we have real numbers with you've negotiated with your seller, we're going to review your closing costs, some of your prepaid expenses for your home purchase, monthly payment options, kind of obviously where interest rates are at, and get all the design work for your financing done. So I meet with all of our clients once they go under contract as well, spend about 45 minutes with them just to make sure we understand all the financing. Now, you are going to have other action items for you as a buyer. You'll have a checklist of items that you'll start to gather for your financing, but you'll also be required to do what we call as an earnest money deposit. That essentially is a good faith investment that you make in the purchase. It's usually the equivalent of 1% to 2% of your purchase price, but it does count towards your cash out of pocket for the home purchase. Now, in your contract, you do have stipulations called contingencies in most parts of the country that essentially protect that deposit, that allows you to get things like your inspections done on your house, get your house appraised to make sure it's worth what you're buying it for, and get your loan approved to ensure that your financing is all secured and committed to. And that usually happens in the first 17 to as high as 30 days within your contract period. Now, I will say in the workflow to go from step 3 to step 6, that's called the escrow time period. It's usually about 30 days. Depends on what part of the country you're in. It could be 45 days, could be 60 days. Some markets that are hyper competitive markets, it can be as short as 14 days. It really just depends. As we move through our steps, step 4 is the administrative functions of the loan. We're going to be doing the administrative work of verifying your employment. We're going to probably re-pull your credit at that time. We're going to verify assets. And we're going to get everything kind of structured properly so we can send everything to the underwriting team who actually underwrites your loan and verifies all your eligibility requirements for the financing. All right. Now, that'll move us over to step 5 in issuance of the loan approval. By that time, we've also got your appraisal back probably for your house. You've had all your inspections. You've had some time to look at those. If you still feel good about the property after all of those things have come in, then you remove your contingencies for the purchase. That tells the seller that you feel good about everything and that you're ready to move to the final closing stages. Now, as part of that process, we're going to issue your final closing disclosure to you that starts a 3-day cooling off period before you get to the very final milestone. Now, throughout the entire process, you're going to be receiving electronic disclosures from us. Your first disclosure comes after your follow-up video session with us. And then as we move through the process, you'll get ongoing disclosures sent to you. Now, everything is done electronically except for step 6. That's the closing of the loan process. You do have to meet in person with a public notary at that milestone. You'll also be required to make your final deposit at that time, whatever your remaining cash out of pocket is. And as your lender, we're going to fund your loan on that date of closing. That includes funding the first mortgage. And if you've elected maybe in assistance programs, we also are funding that resource as well for you too. Now, the signing time takes about 45 minutes to an hour with that public notary. They'll meet you generally where you're at. But that in some states will happen the same day as the closing, which basically is the recording of the transaction. So the local county recorder's office will record a transfer of ownership. They'll also record the deed for the loan. And once that all gets confirmed, we get notified of that as well as your realtor. And we'll call you that same time we get that and say, hey, congratulations, you did it. You're a homeowner. It's a huge accomplishment, massive financial milestone. I get fortunate enough to get make a couple of those calls a day, but it's a huge day of celebration, and we want to be there as your trusted partner to get you to that finish line. Now, our relationship doesn't stop with our clients there because part of our aftercare is, in fact, today is really a big part of today. We're watching rates for clients. So, specifically, some of our clients that bought 2 years ago, part of their aftercare is we're watching their rates go lower. So we're going to look at refinancing. So we'll look at opportunities for you there. Also, you're going to be able to track your home equity progress with our HomeBot system. And we're checking with our clients annually because for us, this isn't just another home buying transaction for us. It's a relationship with you. And we want to make sure that as financial milestones occur for you, obviously it starts with your home ownership, but as things change financially for you, we want to make sure we're there as a resource. All right. I do see some questions in the chat. I'm going to get to those in 2 minutes, but I wanted to kind of let you know how you can get started in the process. If you're interested in connecting with me for your free home buyer consultation in our partnership, there's a real simple 3-step process, an easy online application. We only do a soft credit check. You'll then upload documents, and then you use our scheduling system, which you can see here, to schedule a pre-approval video consultation for you. And that's a 30-minute session that you and I get a chance to just map out that plan for you. Now, some of our clients after class like to at least start with an introductory call just to get a chance to know us a little bit more. That's great too. You can also use our scheduling system to book one of those free sessions as well too. All right. Here's what our consultation looks like. It looks very similar to all the topics that you've heard tonight in our discussion, but we really want to get a better understanding of your budget, where you want to buy, what resources we can put around you, your timeline for buying, and just make sure we have a really comprehensive plan for you around homeownership. All right, last thing I want to point out to you is our technology. We embrace AI and some of the tools we use, but we also embrace mobile. You can start the process right on mobile, whether it's starting, using the calculators there or following the progress of your loan, even submitting your application. We embrace technology. It certainly doesn't replace the human touch in home financing. It's still a big part of what we do. So we're always available for our clients via email, whether it's phone, whether it's text message. We always want to make sure that we're here as a high touch experience for you. All right. And then I want to point out our discount for you. So part of our UF alum partnership is that we discount our services for you and really try to equip you with the best financing options. So we provide a $750 discount in closing costs. Of course, you have access to these free classes that we provide 4 times a year. We'll have a full slate of classes available for you next year as well too. And if you've enjoyed this class, we'd encourage you to share this with your friends, family, your coworkers. I think we have at least probably 20 more classes left for this year. You can find a list of all those classes on our website at mortgageeducate.com. Here's all of my contact information, so feel free to reach out to me. Love to be able to hear from anyone in class that has any follow-up questions. And, I love what our community says about us because that really tells me that we're serving correctly. And so check out what, our clients are saying about us in our local communities, whether that's on Instagram, some of our feedback on Reddit, because that means a lot to us. We understand this is a really big decision for you financially. We don't take our role in that process lightly. That's why we kind of start with educational classes like this. So, we hope that, these tools that you gotten tonight, hopefully you have a couple takeaways, will help equip you to make that journey towards homeownership whenever that works for you. All right, well, that takes me to the end of class. I got a few minutes left before we hit the top of the hour. I know a lot of people are still hanging in there with us. I want to answer a couple questions and I'll stick around for questions. And again, we've recorded tonight's class so you can check out anything that you missed throughout the session. My question I have that I'll go through the class is, so related to the question around down payments, if you want to go over 20% down payment, should you put that extra money towards the interest rate instead and put the first-time homeowners money towards the down payment? So, where you allocate your funds will be more of a strategic conversation we have. I'm not a huge fan of buying down rates right now, which, essentially means paying more money out of pocket to bring down the interest rate. I think if you're choosing to buy in the next year or so, you're probably going to have an opportunity to refinance a couple years from then. I think we probably want to put it towards down payment, but I'd love to be able to have that conversation with you one-on-one and see exactly what that should look like. All right, thank you for that. Let me make sure I'm just not missing anything. Okay, thank you for that feedback. Appreciate that. Any other questions from our class? Okay, you're welcome. Appreciate all the positive feedback on that. Cool. All right. I think we did it. So we'll give you 2 minutes back in your Wednesday evening. Hopefully you got some fun dinner plans. And I hope we get a chance to get connected with you soon. We'd love to help kind of provide a path for you to homeownership. Love to be a partner for you on that journey. So have a wonderful evening, everyone. Look forward to seeing you soon. Good night.